Good morning, good afternoon, and good evening. It's December 9, Friday. And what a wonderful day. How are you, Awi?
Good. Doing good, Mark. Blessed.
All right.
How are you?
I'm good, surviving. Just came back from a trip from the Philippines, so it's been quite an adventure. A short trip, but sweet. So, for our listeners, thank you for joining us. It's episode 64. Sticking with winners. Welcome to the Mark U and Wawi show. This is Mark U.
Wawi Santos.
All right. So basically, we're both healthcare practitioners here in the USA with the same passion and interest in investing our hard-earned money in the stock market. So on a weekly basis, we share our sentiments and also dive in to the latest news or most relevant news that we think would affect our investments over the long term. Me and Wawi have been doing this for the past year, and we try to at least, do this at least once a week. If not, we're gonna make up for it. So on a weekly basis, we jump into our sentiment survey for Wall Street stock market. So this is the American Association of Individual Investors. They survey their investors once a week. So they basically came up with a new survey a couple of days ago, December 7, where it shows that level of investors' bullishness have remained the same compared to a week prior. We are at 24.7%. Meanwhile, bearish investors have increased from 40.4% to 41.8%. So bearish investors just means that they think that the stock market will go down, and the inverse meaning for the bullish investors. So what do you think, Wowie? Are you bullish or bearish on the stock market at this point of time?
For today, I am bullish. For the next 6 months, I'm neutral.
Mm-hmm.
But for the next year, probably the end of the next year, more bullish.
I see. Well, there are a lot of things to consider how to how to gauge the market's path. There's just no way to predict where it's gonna go, but it's good to be aware of the sentiments for sure. So right now we have the fear and greed index. So we take a look at this once a week as well. So at this point in time, we are in greed. We are in 56 points compared to last week's 67. So a little less greedy at this point in time, but still on the greed side of things. Market momentum. I remember me and Wawi discussed this a couple of episodes ago, where usually when the S&P 500, which is the leading in the stock market index that is being followed by not only by regular retail investors but also mutual funds, the biggest ETFs there out there. um, this is where they base their investments, or whether if it goes up or down kind of reflects overall what the retirement portfolios are doing. So S&P 500, it's still above the 125-day moving average, Wowie. I bet this is the longest um, time or duration that the S&P 500 has remained elevated since the start of the
Mhm.
year. So you could tell from the start of the year we have had the sell-off. We're actually in the bear market. For those who are not aware, bear market is when a stock price or an index or a certain price have been down 20% or more.
Mhm.
So
Looks like we hit the bottom in October.
that's what it looks like. Um, so we have been trying to push through or pierce through this. So starting in April, but it didn't last long. April, we only pierced through it and maintained above from March 25th to April 5th. So about a couple of weeks there. And then on August, we tried to again pierce through it, which we did, and we stayed up there from August 9th to August 26th. So at least a couple of weeks again. And then now, the longest time that we've been up above the 125-day moving average from November 9th to present, we're still up. We're still up. So unless the S&P 500 falls less than 3900, That's its 125-day moving average. We're maintaining the market momentum on the upside, which is a little bit bullish or positive for the long-term investors out there. Stock price strength. So net new 52-week highs. We're actually trending above. We're being labeled as extreme greed at this point in time.
Mm-hmm. That's good. That's a good sign.
Stock price breadth also at extreme greed. Put and call options. It says here, as of this update, December 9th, 2 p.m. Eastern Time, we're actually at the neutral side of things. But I disagree with this, as I've seen another report by Charles Schwab, by Liz Ann Saunders, his chief investment officer, indicating that there is quite a record amount of people buying put options at this point in time.
Mm-hmm.
The market volatility. We haven't seen a lot of like wide-ranging movements in the stock market recently. Would you agree, Wowie, or am I mistaken?
No, relatively flat as far as the movement. You know, the S&P 500 tried to break through the last week, but could not. It's been negative for the past almost 2 weeks.
Gotcha. Yep, as we're looking at right now, S&P 500 for the past 5 days. Mind you, right now the market is still open. They're still trading. We're recording this in the afternoon here at Texas time, 1 p.m. So market has yet to close. It'll close around 3:30 Texas time. So for the past 5 days, right, Huawei was right. The market is down 2.28%. And despite it being down, the volatility seems to be passive. Oh,
Yeah,
it's up
somewhat.
2%, yeah. Oh, it climbed up about 12% for the past 5 days for sure. But it's still down 12.8% for the past month. So not much volatility. As we are looking at some of the volatility movement in past couple days. And on to the next market movement. So we're gonna take a look at the 1 week performance of all the industry here in the US. So it looks like not one industry is on the positive side of things. I thought that for some reason that maybe energy is up, but it's actually the worst performing sector for the past
For
week
the
alone.
week.
Yeah,
Mhm.
it's down 6.89%, followed by no other than communication services, which is also most of the time comprises of big tech companies like Google and Facebook. So these guys have been trending down, which isn't good. Consumer cyclical, financial, each and every industry is down on the red for the past 5 days. Meanwhile, for the past 4 weeks, technology is actually the best performing sector. Quite a turnaround for the past 5 days. Would you agree, Wowie?
Yeah, there's a slight turnaround, but I would not hold on to it at this time. Still, they're still waiting on the Fed's action. But right now, Jay Powell is signaling a lesser hike.
Hmm.
So we will see. We don't know for sure, but we will see.
Right. I think they're due to report on December 13th, which is next Wednesday, and it's coming up pretty soon. And we're gonna see how the market reacts to their announcement. Usually, it's an eventful day, right? While the market goes up and down, and volatility increases during that point of time.
Hmm. Yeah, you never know what the market is gonna react
Mhm.
when the Fed moves next week.
Yeah, and that's what the market doesn't like, uncertainty. So if we're gonna take a look, since the start of the year, there's only one sector that's on the green. That's oil, energy. This is mainly because of tight supply and the war in Europe. So that kind of cringes on the or clings on to the fundamental aspect of things, like less oil production, higher demand, so better returns for oil. But the thing now is China has been experiencing a lot of COVID cases, and they've actually shut down about a month ago, and now they have slowly started loosening things up again, which kind of crimped on, I think, in my opinion, have affected the energy sentiment. meaning that there might be less oil demand. That's why the energy as a whole for the past month is negative. So despite it being the best performing industry, it is the only positive industry since the start of the year, energy followed by utilities. So now we might be seeing some changes as the past 4 weeks and the past week alone indicates that a lot of selling has been happening in the oil industry. And I think I've remembered reading a Bloomberg report where it said that one of the JP Morgan analysts, famous analyst, saying that it's time to sell the oil or reduce oil exposure as you know, as it has been performing since the start of the year. Let me see if I could pull it up. Here we go. So it's JP Morgan, Kolanovich, one of the widely followed analysts, saying that um, just to reap your benefits from the year to date winners. So it
Yeah,
says, yeah,
that
go
that
ahead,
would be
Bobby.
a good strategy, I guess, if you're going for profits. Now,
Hmm.
if you're going for income, you
Right,
may want to keep your shares for, for the, your the dividends.
true. Because most of these oil companies are very generous to their shareholders. Chevron, in instance, today it's down 2.7%. They actually have a dividend yield of 3.36%. Exxon has 3.51%. But going back to this JP Morgan review, he said, quote unquote, an enormous gap has opened between energy stocks and the price of energy commodities. Expects Now the JP Morgan analyst says that he expects the share prices to fall more than 20%, but over the long term, still believes the industry is experiencing a super cycle. So if you're going to
Hmm.
take a look at this chart, the West Texas Intermediate oil is now down about 5% since wow, we haven't seen this low of oil since the start of the year. Oil price has actually decreased. So one way or the other, Federal Reserve's effort of taming inflation has been effective, as well as geographical movements. China reopening, or
Hmm.
China slowing down in its economy may lead to lower oil demand, playing into the oil price. But if you're gonna take a look at the S&P 500 Energy Index, it's way up there. There's a wide gap. This is what the JP Morgan is saying. So if eventually if this price catches up to the oil price, which is a commodity, which is harder to predict, then we would be seeing a sell-off in the oil sector. There's something to look for sure. Since we're already close to the end of the year, believe it or not. What a
Hmm.
year. What a year it has been.
Yeah, it's been
Um,
a very slow year for equities, but has been very good on the energy sector for
yeah.
sure.
Yeah, the only winning sector
Hmm.
um since the start of the year. So here's the fund flows that we also take a look at. Where is the money going? According to this Reuters publication that was just published about 7 hours ago, U.S. stock or U.S. equity funds registers biggest weekly outflow in about 1.5 years. So not a few weeks ago, not more than a few weeks ago, meanwhile we were celebrating that we're seeing a lot of money coming back in to the stock
Hmm.
market. But now it's being reported that there are a lot of money going out, biggest in 1.5 years. So what's happening? So this is actually a reflection of the institute uh, in sentiment, where investors are getting less bullish on the market. So wow, this is crazy. Withdrawals of $26.66 billion from U.S. stock market, biggest outflow since April 2021. So is this what do you think about this, Wami? Is this people selling their losers and finally locking those losses in and catching up to the tax harvesting loss, or people are just giving up on the stock market?
I think it's just basically risk off sentiment driving it,
Mm-hmm.
um, and probably a lot of profit making. Uh, so there's a lot of volatility, and retail investors for sure, are taking profits whenever things are up,
Mm-hmm.
and that's what I'm seeing. And you can just look at it day by day as you look at the trades that happens day by day. In the
Right.
mornings, you see a rise, and by close to midday, you see it dwindling down.
Mm-hmm.
So you know that they're buying and selling
Yeah.
a lot during the day.
Yeah. Well, reflecting to our chart previously, what I'm thinking now is you're right. If it coincides with this observation, for example, the energy or oil sector has been selling off since for the past 4 weeks, and at the same time, people are pulling out their money. So it
Hmm.
could be mostly investors selling their winners heading
Hmm.
to the year end. And now they're listening closely to what the biggest US banks are saying as well. Goldman Sachs, JP Morgan, and Bank of America have all warned of a recession as inflation threatens, consumer demand. And if our listeners are not aware, consumer is what drives the US economy, including also as well real estate. So weakness in fund flows definitely observable at this point in time, which is quite a troubling sign. It's
What
quite
I send
contrary.
in what I send in the group is the M1, M2 money supply is
Mm-hmm.
starting to burn. So it's starting to showing signs of weakness now. So people are getting more credit for sure. Um,
Mm-hmm.
so whatever is driving the economy is slowly um, trailing off. So
Mm-hmm.
I just sent that chart to our group, and
Oh,
if
okay.
they see it, that you will see that there's a slight downtrend on money supply,
Mm-hmm.
which is a good thing, and also a downtick on the US dollar value in the past few weeks. So
Right.
that's a good sign.
Mm. So if you guys would like to join us in our messenger group, private messenger groups, just send us an email at markuwawishow@gmail.com and we'll gladly add you in that exclusive group. So for the sectoral funds, look at this, Huawei tech, financials, and consumer discretionary are the ones who experience a lot of outflows. Tech, which is the biggest loser since the start of the year, has lost another 1.27 billion or has experienced 127 billion dollars in withdrawals. So selling your losers for sure, getting that tax harvesting loss. So I
Hmm.
think you can write off at least until $3,000 in losses against your income, right, Wawi?
Yeah, and if you have more, you
Mm-hmm.
can write it off the following years.
Next year, yep. So U.S. investors purchased high yield bond funds, 318 million, and government bond funds, 1 billion. Biggest weekly net purchase since November 16. So investors are looking ways to diversify. So meanwhile, that pertains the fund flows that we just reviewed. That pertains only to the U.S. stock market.
Uh,
Meanwhile,
so,
if we're Mhm.
some movement into China was just noticeable the past 2 weeks.
Oh
So
yes.
you
Mhm.
could see some uptick on equities like Alibaba and BYD.
Right, they've been
Uh,
outperforming, right?
yes, just but it's just a signal, in my opinion.
Yeah, Baba is still about relatively flat for the past 5 days, but for the past month, it's been up 42%. So Alibaba has been waking up
Hmm.
finally since the start of the year.
Hmm.
Well, even since last year, Jack Ma has been, in trouble, been away from the public limelight. So
Hmm.
who knows what he's up to right now?
Well,
Global equity. Mhm.
a lot of fintech is what they're doing on the
Mhm.
sideline
Mhm.
with Mint, MYNT,
Mhm.
and some Indian fintech also.
Right, staying away from China, I guess, but it's hard
Hmm.
because all of his business mainly relies in that geographical location. So, in terms of global stock markets, global equity funds record biggest weekly outflows in the last 3 months. So, not only US has experienced withdrawal, a lot of withdrawals for the past a year and a half, which is might be a little bit troubling, which is a contrarian indicator too, because if you believe in the US stock market and its resilience over the long term, you might want to be buying into things at this point in time, especially in tech, as it has just seen a nearly 1 billion and 6 withdrawal in the past 5 days. So outflows from global stock funds hit 3-month high. So investors offloaded a net $22 billion, week biggest weekly selling since September 7. And a lot of money looks like have flown into the money market.
Mm-hmm.
So a lot of investors are trying to stay passive. They want to keep their money on the dry side, so they want to say so they will be able to use it and deploy it whenever there's an opportunity that shows. So globally, yep, tech, financials, and consumer discretionary experience wide selling.
Well, I think
And
it's smart, if you're getting negative returns on equities.
mhm,
Like I mentioned, my brother has put his savings into CDs, which 1 year is yielding about close to 5%.
wow, that's good.
So for a
5%.
1 year CD.
Mm-hmm. But he
So if
might,
you're look
yeah, go ahead. Go
yeah,
ahead.
for for those that are experiencing the negative equity market, that might be a good rate of return for the
Yeah,
meantime.
yeah. Especially if you do not really follow the market, the stock market on a daily basis, and you just want to make sure that you gain or you earn some interest on your money. Yeah, CDs are good to park your money because you can't move it, you can't touch it for at least a year, right, Wawi?
Hmm. And if you look at the market cycle, whenever the Fed rate hikes, an average, recovery time is about 21 months from the first day that they raise their rates.
Mm, so that's almost 2 years.
Yeah.
And the thing is like if you're still iffy about subscribing to those year-long commitments, there's also a product by the government, the treasury bonds, the
Hmm.
savings bonds, savings EE bonds that gives at least 7% at this point in time, I think, in interest, which
Hmm.
lets you park at least an amount to not more than $10,000 a year. So
Exactly.
it's one way of diversifying too. Park your money there and park your money in some CDs. So that way you would still earn some money on your savings instead of just losing a lot of like uh interest because of inflation over time.
Hmm.
But inflation I think is more than 9% or 10%, right, Wowie? I think we're coming out with a report.
Oh, I don't know. I think we're waiting on the PPI, right? So I don't have the current data.
Yeah, as of November 10, it says that we have increased 7.7% as of last month. So we're still waiting for the this month's PPI. Meanwhile, the mortgage, we're jumping onto the properties or real estate side of things. Mortgage rates, 30-year fixed mortgage rates, which is famous for home buyers out there, have been declining. We have seen the top looks like back in October 20 at
Yeah.
7.37%, and now we're at 6.3%. So we haven't seen this low since September. So no matter how near that sounds, it's been a while. If you're gonna take a look at the graph, it's been climbing up and up and up. And this is interesting because the this kind of reflects what the Federal Reserve is trying to do. They're trying to increase the interest rates. That way that could dampen the demand, which ultimately it already did, right, Wawi? There's been slowdown in home buyers demand index as we have tackled on previous
Hmm.
episodes.
Hmm.
So what's interesting is the interest rates is going down. So there
As
was, mhm,
as well as home prices forecasted to decrease another 12%
yeah.
this
So
coming year.
that's quite interesting because usually, in my opinion, I think as the interest rates climb high, home prices should go down, like inversely proportional. But it's been
Hmm.
going down the interest rates. So this is interesting. What could happen on the next couple of months surely would be revealing for the housing sector, let alone a lot of real estate stocks have already been, dumped by investors because it hasn't been doing good because of low demand and low transactions. We've been seeing big banks, mortgage providers, originators, letting go of their staff because of less demand.
Mm-hmm.
Uh, Now on to the next, what we have been mentioning, the U.S. dollar. U.S. dollar has been weakening as well
Mm-hmm.
since first week of November, November 3rd. So from $112, we're down to $105. So usually this coincides with the S&P 500 going up, right, Wawi?
Mm-hmm. Yes.
But for the past month, if we're gonna take a look at S&P, just gonna make sure. Usually I would bet my money that the stock market will be up. Oh yeah, it is. Yeah, stock market
Mm-hmm.
is up 5.65%
Mm-hmm.
as the dollar has weakened in the same period of time.
Mm-hmm.
So this is no coincidence. Usually if the dollar is stronger, the market is weaker. But at this point in time, the dollar has gotten weaker despite the Federal Reserve trying to hike up more rates. I think Jay Powell had indicated that he will hike up at least 50 basis points, no longer the 75 basis points, around sometime next week. So our
Yeah,
investors,
I'm hopeful that he really is going to do it that way, to avert a recession. It's about
Mhm.
60% chance that we're gonna get a recession.
Yeah. So looks like investors are finding it a good signal. S&P 500, if you're looking at the long term, it's been up 5%, and it's almost down negligibly in the past 6 months too, down 1.43%. But obviously, it's still way down since the start of the year, down 17%. So something to look at for sure. We have been seeing some sort of stability nowadays, at
Yeah,
least for the past
something
6 months.
logical, something rational now.
Mm-hmm.
But again, the rationality may go away the first day that they put that 50 or 75 basis points
Right.
next week.
A little bit bouncy ride for sure. Never goes away. Crude oil, like what me and Maui had just mentioned. Look at that. We haven't seen this low since December of last year. $70 a barrel.
Chances are it's gonna go up again when China reopens.
Mm-hmm. Maybe just now we're seeing some sort of softness, but we'll see. I was wanting to go to the lumber. Where's the lumber? Boom! What a sell-off on the lumber. I used to remember us discussing lumber price last week. It was shooting up to over 1,000, which it did, almost 1,400.
So
But now it's
relatively on the
400.
downtrend,
Yeah,
that's a
for
good
sure.
sign.
It's way down compared to last year's. Look at that. Now it's back to almost where it was in January of 2000 or June of 2020.
Mhm.
So we're seeing some settling down of the wild movements. Gas at the oil pumps, or what do you call it? Price at the gas pumps, it's down as well to $3.25 from $5 back in June. So oil as a commodity, this actually is kind of troublesome for me as an oil investor, as I have Exxon and Chevron, and I think I also have Kinder Morgan as pipeline, because this kind of will impinge on their profits. So mind you, they just recorded the best ever quarter, best ever year, not so long ago, about a quarter ago. So this huge drop right here, if a company of oil company is just exposed to that side of things, the refining, and that's where they get their profits, then this might be a troubling sign right here, because that indicates quite a steep drop, which could affect their bottom line. Nonetheless, I think I saw ExxonMobil came out with an announcement yesterday that they're gonna be buying or allocating $50 billion in share buybacks, which is I'm happy for, but I really
Yeah,
do not agree if you're gonna buy your stock at very high price point where they were at. Mhm.
they made some very good move, moving out of Africa, where a lot of their holdings are being stolen, by
Yeah,
oil thieves. So they're unloading that risky portion of their asset. So I think that's a good move as
right.
well.
Mhm.
And
And
plus the refineries that they're building in Houston,
mhm.
is on the way. So it's just a capex right now, but you should see a strong movement once China opens and a strong demand for oil.
Right. Yep. It's only a matter of time. Once oil demands gets back up, I'm pretty sure oil will bounce back. But the thing is, most of these analysts are already indicating that it won't. So pick your poison, see how well you would be able to manage through it. It's good to have some exposure to it for sure, but
Mm-hmm.
we'll see because a lot of investors are already giving up or at least realizing their profits on the oil sector, as we have seen earlier on this episode. So this is a Chicago Financial Conditions Index. We take a look at this, me and Wowie, on a once in a while basis. So if you can believe it, we're actually seeing loosening again, despite the Federal Reserve trying to hike up rates in a nice manner. So we've been trending down since October 7th until December 2nd last week. So this might not be pleasing to Jerome Powell's eyesight because he wants slow down. Meanwhile, the yield curve inversion. So meanwhile we have been taking a look at we've been following this for a while.
Oh,
So this is from the Bloomberg chart yesterday. So we are in extreme. Yield curve inversion reaches 4 decades, 40 years of extreme. So whenever this yield curves inverts, it's no longer a healthy sign for an economy for the next year or so. So we are at the most extreme territory at this point in time. So this is not good. Most of
yep.
the big banks are already forecasting recession so by next year. So this might not be good in the stock portfolios in the coming few months, but who's to say? Federal Reserve can pull up some magic from their sleeves and avert this recession, but we're never too sure. And as long as inflation is way up there, that's the catch 22 at this point in time, right, Wawi?
Yeah, and there's a lot of movement right now. There's still a lot of buying power. When it runs out, that's when when that strong demand runs out. That's when the recession will happen.
Yeah. Yep. And mind you, like we had the technical recession on summer, right, Wawi? When we were calling it as a recession and a lot
It
of like
is
Wall
it is a
Street
recession.
Wall Street analysts are saying it's not, but to each his own. So we only have about 4 minutes remaining in this podcast. If you're still with us, please subscribe and like this video so that I could reach other people who are interested in this type of information. This is for free. We don't get paid for this, but we have just the interest to do so, right? Mommy?
Hmm. Yeah,
So
with regards to oil, a
mhm,
lot of the ships that are gonna move goods throughout the world is using, heavy fuel oil. So
mhm,
I don't think we have seen enough of that demand until the main distributor of goods, China, opens up.
now that you mentioned, interestingly, is Apple or one the biggest company here in the U.S. is actually trying to open up other production areas in India and Vietnam. Whereas we actually saw in our messaging group that Vietnam is actually, or India's stock market has reached new all-time highs this year as of
Well,
recent because of this.
well, they call it de-risking. So they're
Mm-hmm.
onshoring to the United States, Taiwan Semiconductor, all these semiconductor companies moving here and moving production to Vietnam and other Asian countries.
Right.
But they all will need a way to distribute those products,
Mm-hmm.
either from the United States or from Asia.
Right.
And you need those ships.
Yep. And what else could power those ships except for the black gold of
Black
oil?
gold right now.
So before we end this episode, we're just gonna highlight here the troubling things that we can easily um, obtain if we just look at titles or the topics. So this is a
Mm.
publication from Bloomberg. It says Carvana's founder's fortune plunges 98% as firm burns through cash. So if you're not aware, listeners, Carvana's stock price has slumped nearly 99% since last year. And Ernie Garcia III says here has seen his fortune fall $6.7 billion this year to 119 million, according to the Bloomberg Billionaires Index. So this doesn't highlight what this guy did a year ago when the stock prices was all-time high. So according to this publication September of last year, Carvana CEO's dad goes on a 3.6 billion stock selling spree.
Oh, I see.
So he actually sold and had realized $3.6 billion already. So this guy is rich. So if we're just gonna take a look at this by face value, it doesn't mean it would mean that, oh, the poor guy, lost a lot of money. But man, he already booked his gains last year.
I
Uh,
told you, profit taking is the name of the game right now.
yeah. Well, he took it on a really good timing back last year
Mhm.
when Carvana was all time high, and now shareholders are suffering and debt collectors as well. So always pay attention to what the founders are doing. If they're selling a bunch, that could be an indicator that might be a good sign to sell. So I don't think we have enough time to proceed with our next slides here, but I hope most of our listeners have been able to follow through with our kind of like discussion here and tune in onto the next.
Mhm. And don't forget to like and subscribe and support our talk. Um, and
Yes.
message us if you want to be a member of our group.
All right. Once again, this is Mark Yu signing up.
And Jose Wawi Santos signing out.
All right. Guys, have a good one.
Have a good one.